So what's a put option? So in part 1, we talked about call option, which gives you the right to buy shares at a certain price before an expiration date. A put option is the opposite. So we think of putting of selling, right? So a put option is a contract. So if you buy a put option, you're buying a contract that gives you, the buyer, the right. Now you've got the right to sell 100 shares of a particular stock at a predetermined price. And again, we call that the strike price, which you want to lock in. And you can do it anytime before or on the expiration date. So when would you use a put option? For example, let's imagine you are owning, again, let's go back to Coca-Cola, right? So let's imagine you own shares of Coca-Cola over the years, and it's gone up to a price of, say, $60. You're pretty happy, right? And you know that in the long run, Coke shares will continue to appreciate. But you've heard that, hey, now's a bear market, recession is coming, chances are the price of Coca-Cola and the rest of the market is going to fall. So you're afraid that Coke shares are going to drop. So you want to protect your portfolio. So what do? You buy insurance. So a put option is kind of like buying an insurance contract. So you could buy, for example, the Coke 60 put options. So what does it mean? So this means that by buying this option, you have the right to sell Coke shares at $60 before an expiration date, which could be again 30 days or 60 days or even 3 years, up to you to choose the expiration date you want. And for that, you have to pay a premium of, I don't know, for example, you got to pay a premium of, say, $3, for example. All right, so once you've bought this put contract, what does it mean? It means that if Coca-Cola shares were to drop to, I don't know, drop to $40 within the expiration date, you still have the right to sell it at $60 to the person who sold you the put option, right? So in a way, you have locked in your sales price of $60. So no matter where Coke drops to, even if Coca-Cola drops to 0, you still have the right to sell it at $60 before the expiration date, right? So you can see how put options are used just like an insurance policy. Like you've got a car that's worth 100 grand, you want to insure the car, so you pay a premium, right? So if someone steals the car or it burns down, you still get 100 grand from the insurance company. Make sense? Now, you can buy a put option to protect shares that you already have. Or you could also buy a put option without owning any shares at all. So for example, if you think that Coke shares are going to go down and you want to profit from its decline, you can also buy a put option on Coke shares. So you could buy, again, the Coca-Cola 60 put, right? That gives you the right to sell Coke shares at $60 before the expiration date. And again, you could pay a premium of $3. So what will happen if Coke shares were to drop to $40, for example? You're really happy, right? Why? Because with the option contract, you have the right to sell Coke shares at $60, right? But right now it's at $40. So what could you do? You could easily buy the shares in the market, from the market at $40 and sell it at $60, making you a profit of $20. All right, so you can use put options to speculate and profit as the price goes down, because you can still sell it at the strike price. So what does a put option look like? So typically a put option will look something like this. For example, you may see something like Facebook, FB, January 150 put at $5.80. So what does this mean? So the way you read it would be, the first thing you see would be the stock which the put option is written on, the underlying security. So in this case, it is Facebook, right? So you're buying the Facebook January put options, which means this option expires in January. And again, it always expires on the third Friday of the month for monthly options, which is most of the time the options that we buy. So it will expire on the third Friday of December. Got it? The next thing you see is 150, and 150 is the strike price, right? So this should be 150, right? That's the strike price. That's the price which you are locking in to sell the shares at to whoever sold you the put option. Next, it says put instead of call, it's a put, and the premium you pay for this right is $5.80. All right, so let's take a closer look at this whole transaction. So again, in the market, you could be a put buyer or you could be a put seller. Right? You can take, either role in the market, right? So as a put buyer, what happens? You pay a premium to the put seller who collects the premium, right? And by paying the premium, you now have the right, as the buyer of the put, again, I repeat, you have the right to sell the stock to the put seller at a predetermined price called the strike price. So in the case of Facebook, it's $150. So as a put buyer, you want the price to go up or down. Think about it. Yeah, you want the price to go down, right? Because if the price goes down, you are making money. Why? So again, imagine if you buy a put at a 150 strike price, which means you have the right to sell Facebook at 150. So if Facebook drops to $100, you are happy, right? Why? Because you have the right to sell it at 150, but it's not at $100, which means theoretically, you could go into the market and buy the shares at $100 and sell it at 150, making a $50 profit. So this means your options have an intrinsic value of $50, for example. All right, we'll learn more about intrinsic value in a short while. Now, how about the put seller, the person who sold you that put? The person who sold you the put collects the premium from you. And the put seller is kind of like the insurance company. They sell you this insurance contract, they collect your premium, but now the put seller is obligated. They are obligated to buy the shares from you at the predetermined price, which is called the strike price. So as a put seller, you would like the share price to go, there you go, you like the share price to go up or to go sideways. Why? Because when that happens, the put option expires worthless. And as a put seller, you collected the premium and got some free money. And you're not obligated to do anything, right? So for example, if the put seller were to sell the 150 put option to the put buyer, and the share price of Facebook went up to 160, for example. So if Facebook goes up to 160, what happens to the put option? Right? The put buyer has the right to sell shares at 150, but now the price is at 160. So the option no longer has any value, because why would I sell it at 150 when the market's at 160? And that's why the put option expires worthless, and the put buyer so-called loses money on the put option, but the put seller collects the premium for free. And that's why there are people out there who make money selling puts, because they sell the puts, and as they sell the puts, they're hoping it expires worthless and they're collecting premium consistently. And that is one of the strategies that you will learn in this program. So this is no different from being an insurance company. Insurance companies, for example, every year they sell you car insurance, right? Which is an annual contract, and they're collecting premiums from you every single year, right? And they're hoping that your car doesn't get into an accident, so they collect the premiums and they're not obligated to do anything. But of course, once in a while, if your car gets into an accident or gets burned down, the insurance company is obligated to pay you the value of your car. So as a put seller, you've got the same risk, right? You're selling put options and you're hoping that the share price will not go down so you can collect the premiums. But of course, if the share price goes down, what happens? Now as a put seller, you're obligated to buy the shares at the strike price. So even if the shares go to zero, you still have to buy it at the strike price, which is $150. So is that risky for the put seller? Yes, it is, if again, you are selling the puts in a naked way and you do not want to own the shares, it can become very, very risky. But I mentioned earlier on in part one, this is one of Warren Buffett's strategies of how he makes a lot of money. Because for Warren Buffett, he wants to buy the shares anyway, right? He wants to buy, say, Coca-Cola at a very low price. So what he does is he doesn't mind selling put options and he collects premium. So if the share price goes up, Warren Buffett takes the premium, doesn't have to do anything, and he's happy. If the share price goes down, Buffett has the obligation to buy the shares at the strike price, which he wants to do anyway. So for a long-term investor, selling put options on shares that you already want to own is a win-win situation. It's a no-lose situation, right? And again, you will learn more about the strategy later in the course called selling a cash covered put. All right, so with that, let's learn a bit more about the profit and risk profile of buying and selling put options. So let's take a look at our risk to return profile of buying a put visually. So again, let's go back to the charts, let's go back to the graphs, and again, how do you read this graph? So again, we've got the y-axis and the x-axis. On the y-axis, we have got profit and loss, right? So that's the zero line. Anything above that is profit. Below that would be a loss. On the x-axis, we've got the share price, the stock price increasing as we are moving towards the right. So notice that for a put option, what does it look like? You make money when the price goes down. So when you buy a put, you make money when the price goes down. Hence, notice when the stock price is going towards the left, right, you're making money, shown by the green arrow going up. And if the stock price goes up, you are losing money when you buy a put option, right? So the question is, how much can you lose when you buy a put option? When you buy a put option, your maximum risk is the premium that you paid for the put option. So in the case of Facebook, we buy one contract at say $5.80. So again, that's our premium. Remember, one contract equals to 100 shares. So 580 multiplied by 100 shares is $580. So that is your maximum risk in buying an option. It's the premium that you paid for it. So hence you can see that this red line over here, right? Your maximum risk is capped to $580 over there, $580. Okay, that's the worst that can happen if the price goes up and you buy a put. Now, if the price goes down, you're making money, right? Because it's a put option. When the price goes down, you can buy it cheap, theoretically, and sell it at a higher price, which is the strike price. And you can make that profit. So when the price goes down, what is your profit at expiration? Now notice that this chart shows you the profit at expiration. So if you were to sell the put before expiration, you actually get a bit more money because that's what we call extrinsic value, which we'll talk about later on. So right now what we're looking at is the intrinsic value of the option. So at expiration, the profit you make would be equals to the strike price minus the stock price minus the price of the premium that you paid. All right. So again, in the example for Facebook, if you bought the 150 put, right? And let's imagine now that Facebook shares went down to $130. So what does this mean? It means that theoretically you could buy Facebook shares at $130 and sell it at $150, which means you have got a profit of $20. So that means your option has an intrinsic value of $20. And $20 minus $580, which is the premium you paid, is $14.20. So that's your net profit. Multiplied by 100 shares, that's $1,420 in profit. So you can see from the chart, if the price drops to 130, your profit will be, ta-da, 1420. If the price drops even further, your profit will be even higher. And again, the more the share price drops, the more profit you make. Now, of course, there's a limit because it can only go to zero, right? Now, imagine if Facebook goes to zero, you make the maximum profit, right? Because if Facebook goes to zero, it means theoretically you can buy Facebook shares at zero and sell it at 150. Wow, which means you make $150 profit minus 580. That will be your maximum profit, which will be about $144 thereabouts, right? All the way up there. But it's unlikely to happen, of course. Now, what's your break-even price when you buy a put option? When you buy a put option, your break-even price is equal to the strike price minus the premium that you paid. So in this case, the strike price is 150 minus the premium of 580. Your break-even is 144.20. In other words, when you buy this put option with a strike of 150, the price of Facebook has to drop below 144.2 for you to make money at expiration. But again, if you sell it before expiration, your break-even is a lot higher because you have got what we call that extrinsic value again, which I'll explain in the later slide. All right, so now that we understand the risk profile, the profit profile of a put buyer, how about the put seller? If you are put seller, this is what your risk return profile looks like. And it's the opposite, as you can see. So again, on the y-axis, we've got profit and loss. So anything above zero is a profit, below a zero is a loss. And on the x-axis, we have got, again, the stock price, right? Increasing and decreasing. So you can see that when you sell a put, you want the stock price to go up. As the stock price goes up, you make your maximum profit shown by this green line. That is your maximum profit, which is the premium that you collect. If the stock price goes down, you can see that you could potentially be losing money, because as a put seller, you're obligated to buy the stock at the strike price. So even if the stock price drops by 30-50%, you still have to buy at that higher price, which is the strike price. And you could make a potential loss if you sell it at the lower price, hence that down curve. So again, let's take a closer look. What's your maximum profit as a put seller? It is the premium that you collect. So again, if you're selling one contract of Facebook 150 puts at 580, that's your premium. So 580 multiplied by 100 shares, your maximum profit is $580, which is represented again, this green line over here. So you've got a limited return as a seller of a put option. What is your potential loss? Okay, so again, remember that when you sell a put option, you are obligated to buy the shares at the strike price. So if the share price goes down from 150, the share price goes down to, say, 130. What does it mean? It means that now you are obligated to still buy the shares at 150, right? So if you buy the shares at 150 and it's now worth 130, guess how much you've lost? You've lost $20, right? So hence 130 minus 150 is you've lost $20, but you've collected the premium of 580. So your potential loss would be the stock price minus the strike price plus the premium. So in this case, 130 minus 150 is minus 20 plus 580, so that's $40.20 that you've lost. Multiplied by 100 shares, that's 1420. So you can see when the share price drops to 130, you're losing $1,420. If the share price drops to 120 or lower, then of course you lose more and more. Why? Because the share price is worth less and less, but you still were obligated to buy at 150. All right. But again, if you believe that the shares are of a fundamentally good company like Warren Buffett. So like I said, Warren Buffett, he uses this technique. He sells put options because he doesn't mind buying it at 150, because he knows even if it goes down to 140, 130, 110, it's temporary. In the end, eventually it will go higher. So only use this strategy if you are willing to hold the shares in the first place, because you know fundamentally it's a good company, right? But if you're not, then it's really, really risky to sell put options naked. Now, you will learn a strategy in the lesson that when you sell put options, it's like, again, you're selling insurance, but you have to protect yourself by buying reinsurance. So we call that a put spread, and we'll be talking more about that later in the course on how you can become a great insurance company selling contracts, but reinsuring your insurance policies, which makes it a lot safer. Now, finally, what is your break-even price as a put seller? Your break-even price would be the strike price minus the premium. So in this case, it's 150, which is strike price, minus the premium, 580, 144.2, which is over here. So in other words, as long as the price remains at 144.2 or more, you're making money. If it goes below that, then right, you're obligated to buy the shares at that strike price when it's lower, and you could potentially lose money in the short term. All right, so let's take a closer look at understanding the right versus the obligation. Remember that when you buy an option, you always have the right, but not the obligation. So option buyers have the right. So for example, if you buy a call option, right, as a buy of the call option, you have the right to buy the shares at the strike price. Now, you're not obligated to do it, you don't have to do it, you just have the right to do it. So if you exercise your right and say, okay, I would like to buy the shares at the strike price, you are exercising the option. Most of the time as option traders, we never exercise our options. So in that case, how do we make money? Well, very simple. Basically, when we buy a call option, all right, we buy it at a certain premium, right, certain price, right? And what happens is that if the share price goes up enough, the premium of the call will also go up in value, and we sell it at a higher price. So we buy the call at a lower price, we sell it at a higher price, and that's how we make our profit without actually having to buy the shares and selling the shares later on. Make sense? Okay. So in the next part of this lesson, you'll be learning about what determines the price of the option and how do we know how much the price of the call option will go up when the share price goes up. But in general, remember this: when share price goes up, call options go up, and we profit by buying them at a lower price, selling them at a higher price. Now, similarly, as a put buyer, when we buy a put option, we have the right to sell the shares to the put seller. And if we exercise our right, we are exercising the option. But most of the time, we don't do that. We don't actually have shares that we want to sell. Okay, so again, how do we make money as a put buyer? So as a put buyer, we buy a put because we think that the share price will go down. And if the share price goes down enough, our put options will increase in value. So we buy the put at a lower premium, share price goes down, the premium goes up, we sell it at a higher price or higher premium, we make profit, and that's the difference. All right. So in general, when you buy options, you have limited risk, because what's the worst that can happen? The worst that can happen is that the option expires worthless and you lose your premium. So the maximum risk is the premium that you pay. Now, how about the call seller? So again, now remember, as a seller of a call, when you sell calls, you no longer have the right, but you have the obligation. You're obligated, right? So as a call seller, when you sell a call, you are obligated to sell the shares to the call buyer at the strike price. So even if the price goes to the moon, you still have to sell it at that low price. So the higher it goes, the more you lose out, correct? Now, at the same time, as a put seller, you are obligated to buy the shares at the strike price. So even if the share price drops to zero, you still have to buy it at the strike price. So in other words, as a put seller, you are exposed to potentially unlimited risk of loss. Think about it. If you sell a call and the price goes up to the moon, what happens? Right? You're obligated to sell the shares at, say, $20. You have to sell it at $20, but now it's at $50. So what? You have to buy it at 50 and sell it at 20. So the higher it goes, the more you could lose as a call seller, right? At the same time, as a put seller, you're obligated to buy the shares at the strike price at, say, $10. So if the share price drops all the way to zero, you still have to buy at $10, which means you buy at $10 and now it's worth zero, you could lose a lot of money, right? And that's why option sellers are exposed to unlimited risk. So as an option seller, remember, or to be specific, if you're a call seller, if you sell a call, you're hoping that the share price will either go down or go sideways. And so the call will not go up, you expire worthless, and that's what you want. Because if the call expires worthless, you sold it, you call it the premium is worthless, you have no more obligation left, right? As a put seller, you're hoping the share price would go up or go sideways. If that happens, the put expires worthless and you no longer have an obligation. So that's how it works. So many people would think, hey, in that case, I should only buy options, right? Because if I buy options, it's limited risk, unlimited return. I should never sell options, correct? Wrong. Yes, you can make money by buying options, but at the same time, many professionals actually make money by selling options. Now, you may ask, but why would they want to have unlimited risk? Well, there's a way to do it to cap your risk, which is what you're going to learn in the rest of the course. Now, why do we want to sell options instead of buy options? Because let me tell you a very interesting fact. And the fact is this: 90% of options expire worthless. Think about it. 90% of options that you buy, whether it's a call option or put option, will expire worthless. So in other words, if you buy a call hoping the price will go up and you make money, your chance of being right is 10%. If you buy a put and you want to make money when the price goes down, your chance of being right is only 10%. Why? Because for you to make money, the price has to move in your favor enough within that period of time. If it doesn't, it expires worthless. Now, if you learn the right technical analysis strategies, which you're going to learn in this course, yes, I'll show you how to be the 10%, how to make money by buying calls and making money when the price goes up, and selling and buying puts and making money when the price goes down. But at the same time, remember this: as an option seller, you now have a 90% chance of being right, because 90% of the time, the option will be worthless. But you may say, but Adam, what about the unlimited risks? I'm taking a lot of risks, right? So you never ever sell options naked, which means you sell options and expose yourself to unlimited risk. So in the course, you're going to learn how to sell options, kind of like selling insurance, but to buy reinsurance, to reinsure yourself. So if shit happens and it doesn't go the way you want, you are protected. And that's the beauty of this course. We're going to learn how to make money by being an option buyer and option seller, and the best strategies to profit in both directions. So with that, let's learn about how to understand option prices and how they move up and down with the share price. So here's a table summarizing what we've learned so far about calls and puts. So again, on the call side, you could be a call buyer or a call seller, all right? So as a call buyer, how do you make money? You want to buy the call at a low price, at a low premium, so that the call will increase in value and you sell it at a higher price. So buy low, sell high, that's how you make money. So you want to see that the stock price goes up as a call buyer. So when the stock price goes up, the value of your calls will increase and you make as much as you can. When the stock price goes down, the value of your calls decrease and they could expire worthless. And again, you have limited risk because the most you can lose is the premium you paid for the calls. So for a call buyer, you profit when the price goes up, and you have to be really bullish to profit from buying calls. Now, on the other hand, if you are selling the call, how do you make money? Well, you sell the call and you get the premium, right? So as a call seller, you want the value of the call to go down, because sell high and become worthless. So you collect as much as you can. So when does the call decrease in value? Again, when the share price goes down. So when the share price goes down or doesn't change, the call will eventually become worthless. And when the call becomes worthless, as a seller, you are happy because you sell something and now it's worthless, you have no more obligations. So you maximize your profits when the stock price goes down or goes sideways. But if the stock price goes up, what happens? You're not too happy, because if the stock price goes up and the value of the call goes up, you're losing money. Because remember, you sold the call, now it's at a higher price, you have to buy back at a higher price. So sell low, buy high, you're losing money. Remember, when you're selling a call, you want the price to go down and become worthless, you maximize. When you're buying a call, you want the price of the call to go up and you maximize. All right? Okay. Now, on the put side of the equation, when you buy a put, how do you make money? Again, you buy the put at a certain premium, at a certain price, and you want the value of the put to go up. The higher it goes up, the more money you make. Buy low, sell high. So when does the put price go up? The put price goes up when the stock price goes down. That's right. So you see, when the stock price goes down, the higher the put price increases, the more money you make. Okay? But if the stock price goes up, what happens to the value of the put? The value of the put will go down and eventually expire worthless. And the most you can lose is the value of the put, which is the premium you paid. So your downside is limited as a put buyer. Now, when you sell a put, how do you make money? When you sell a put, you want the put price to go down, right? Because sell high, you're hoping after you sell it at a high premium, it will go down and become worthless. So in other words, when you sell a put, you're hoping the stock price will go up and the put will become worthless, and you maximize your returns by selling that put. Or if it goes sideways, you also maximize your return because the put expires worthless. But if the stock price goes down and the put value goes up, then you're losing money because you sell the put at a certain price, the put price goes up, you sell low, you have to buy back high, you're losing money. So remember, whenever you sell a put, you want the put price to go down and expire worthless. So as a put seller, you are bullish, you profit when the price goes up or goes sideways. So that summarizes how you trade calls and puts. So let's learn how to determine the intrinsic value of call options, because when you buy a call, you want the intrinsic value to increase. And if you sell a call, you want it to decrease and expire worthless, right? Okay. So when you take a look at the option chain, you can see that for any stock, for example, Apple, you've got all the different options available at different strike prices. So again, these are the strike prices: 230, 225, 220, 215 and 210 strikes. So again, you could select and buy any option at whatever strike price or sell any of the options that you want. So what are these options worth? Okay, well, it depends. So let's imagine right now Apple shares are selling at $220. So this particular option has a strike price of 210. What do you think it's worth? Well, if you were to own this option, it means you have the right to buy Apple shares at 210. But right now Apple shares are at 220. So if you buy it at 210 and sell it at 220, you could make a potential profit of $10, which means that this option is worth something. This option is worth an intrinsic value of $10, and it is in the money. So you can tell that the intrinsic value is basically the stock price, 220, minus the strike price. There you go. Now, how about this option that has a strike price of 215? What is this option worth? So again, if you own this option, it means you have the right to buy Apple shares at 215. So you could buy at 215 and you could sell it at the market price for 220, making a potential profit of $5. So again, this option over here has an intrinsic value of $5, and it is in the money as well. Now, what if you have this option? If you look at this option, which is the 220 strike price option, it is not worth any intrinsic value at all. It is at the money. Why? Because if you own this option, you have the right to buy Apple shares at 220, but it is already at 220. So what? The option has no value, or no intrinsic value for that matter, right? So zero intrinsic value. Now, similarly, as we go, if we look at options with higher strike prices, like this option over here, 225, what is this option worth? Well, again, if you own this option, you have the right to buy Apple shares at 225. But why would you want to do that? Because Apple is now at 220, right? There's no value of buying it at 225. So this option over here with the strike price has zero intrinsic value. Same thing, this one has zero intrinsic value. So they are out of the money. So does that mean that this option, and this option are worthless? No, they are still worth something. Although their intrinsic value is zero, but they have got extrinsic value, which is made of what we call time value and volatility. Now, extrinsic value is also known as hope value, right? So this option, which has a 230 call, may be currently out of the money, But if there's a long time to expiration, if there's a long time value, or there's high volatility, there's hope. There's hope that Apple's stock price could go up. And if Apple's stock price goes up, then this option will become in the money. All right. So the longer the time to expiration and the higher the volatility of the stock, the more hope there is. So this option would have extrinsic value or hope value. But once it expires, that extrinsic value becomes zero. There's no more hope left, right? And the only value becomes the intrinsic value. So how about put options? What's the intrinsic value of a put option? So again, let's take a look at Facebook, for example. And these are the different options at the different strike prices. So let's imagine currently Facebook's stock price is at 150. That's the market price. So if you take a look at this put option, it's the 160 put. What do you think this put is worth, right? So if you own this put, it means you have the right to sell Facebook shares at 160. You have the right. But you could buy it at 150. So technically you could buy the shares at 150, sell it at 160 and make $10. So this option has an intrinsic value of $10. It is in the money. So for put options, the intrinsic value is the strike price minus the stock price. It is the opposite. So you take the strike price 160 minus the stock price, that's your intrinsic value. Similarly, how about this option with a 155 strike price? What's it worth? Again, it's worth something, because if you own this option, you have the right to sell the shares at 155, but now it's at 150. So you could buy it at 150 from the market, sell it at 155 to the put seller and make $5. So the intrinsic value is $5. And again, this option is in the money. Now, similarly, if the strike price of the option is the same as the market price, then the option is at the money and there's no intrinsic value, because you have the right to sell it at 150, but it's already at 150. So there's no intrinsic value to the option. And how about the 145 and 140 and 130 put options to come? They are all out of the money, because again, all these options, their strike prices are below the market price, which means if you own this option, you have the right to sell the shares at 145. But why would you do that? Because the share price is at 150. So these options have no intrinsic value. So zero intrinsic value. So again, does it mean that these options with these strike prices have no value? They are free? No, they have a value. And again, the value is called the extrinsic value, which again is made up of the time value and volatility. So again, extrinsic value is known as hope value, because if the option has a long time to expiration, it expires in 3 months or 4 months, and the share price is very volatile, it means that the share price could go up, it could go down, and if it's very volatile, there's still a chance, that Facebook share could go all the way down to say 130 within the next 6 months, and then this option will become in the money by $10, and this option will become in the money by $15. So as long as there's hope, as long as there's the time left to expiration and there's volatility, these options you see here have extrinsic value. And again, extrinsic value is made of time value and volatility. But the moment it expires, there's no more extrinsic value. Intrinsic value is all the value that the option has. So once again, option price, the price of the option, or what is known as a premium, is determined by intrinsic value, the part of the option that's in the money, and the extrinsic value or the hope value. So if you buy a call option, you want the option price to increase, right? So you buy at a low premium, you sell at a higher premium. So what would increase the option price or the option premium? It's the stock price. So as the stock price increases, what happens? The intrinsic value will increase and the option price will increase. And that's how you make money. It becomes more in the money, right? At the same time, if you buy a put option, how do you get the intrinsic value to increase? when the stock price goes down, the put option increases in intrinsic value, and this increases the option premium, and that's how you make money when you buy a put option. So again, buy at a low premium and sell at a higher premium. Now, on the other hand, you also have got the extrinsic value. Extrinsic value is made up of time value and volatility premium. So what does time value mean? So if you buy an option that has got 6 months to expiration, do you think it's worth more compared to one with 10 days to expiration? Yeah. So the more time you have, the higher the price of the option. But once you buy the option, every day that passes, time value is going down. So as time value goes down, because there's less and less time, your option price goes down. So options are known as decaying or wasting assets. The moment you buy an option, right, every day that passes, you are losing money because of the time value going down. So once you buy an option, you want the price to move up if a call, move down as a put as soon as possible, because if you wait too long, it will expire worthless in terms of the extrinsic value. So again, extrinsic value, the time value declines to zero at the expiration date. Now, the other part of extrinsic value is known as the volatility premium. And that's something that a lot of people ignore, but it's very, very important, right? When market volatility is high, the market is very volatile, what happens? Option prices increase, both calls and puts. When volatility drops, option prices fall, both calls and puts. So in general, if I'm buying an option, I want to buy when the price is low, so I can sell it higher, right? So I only want to buy options when volatility is low in the markets. And in this course, you're going to learn how to measure volatility using a term known as implied volatility. At the same time, if you want to sell options, you want to sell it high. So you only sell it high when volatility is high. It's kind of like during hurricane season when things are very volatile, insurance on houses increase in premium because there's a chance the house is going to get blown down. But when it's not hurricane season and the weather is not volatile, what happens? Premiums on houses drop. So it's the same thing in the market. So to really understand how to profit in trading options, you have to understand the intrinsic value and the extrinsic value as well. So let's take a look at how to read an option chain. So whatever broker you're using, you can log onto the platform. I'm using Thinkorswim, and you can look at all the different option prices that are available to be bought or sold at different strike prices. And again, you can trade options on stocks, on ETFs, on indexes, on currencies, and on futures. So in fact, in the professional options trading course, we're going to be focusing a lot on trading options on indexes, currencies, and futures, and stocks as well. So for example, let me just key in a stock, Coca-Cola. All right, so once I key that in, the first thing you see is the option chain over here. And the option chain will show you all the different options at different expiry dates. So for example, this one over here, it's expiring on the 7th of December 2018, which is tomorrow. So this is 1 day to expiration. And you've got one which is further out, which expires on the 21st of June 2019. And that's 197 days to expiration. That's almost half a year to expiration. So obviously, when you buy an option with a longer time to expiration, it's going to cost more. It's a higher premium because there's more time value left. So when you buy an option, you want to ensure that it's got enough time value left so that you can be right and the price goes in your favor. So you always want to select one with at least 2 months to expiration. So let's look at this one, which is 71 days to expiration, which is more than 2 months, expires on the 15th of February 2019, which is again next year. So let's take a closer look at that one. I'm going to click on this option chain and scroll down. So there you go. So you've got all the different options. On the left, we have got calls. On the right, we've got puts. And in the center, you have got all the different strike prices, which you can choose which strike price that you want. So currently, the price of Coke is $49.38. Now, before you select an option to buy or sell, you have to look at the delta, the gamma, the theta, and the vega. Now, what the heck does that mean? These are what we call option Greeks, and they tell you about the option. So I'm going to explain that in a short while. Just hang on for a while. This is the bid price, which is the price you're going to sell at. You're going to sell at the market, and the ask price, the price that you buy at the market. So let's take a look at an example right now. Let's look at this particular option, this call option with a strike price of $41. All right, so I'm going to highlight this line. Okay, so notice again that this is the 41 call strike. So what does it mean? It means if you buy this option, you have the right to buy Coke shares at $41. And Coke shares are now $49.38, which means with this option, you can buy it at 41 and sell it at $49.38. So you can make a profit of $8.38. So this means that this call has an intrinsic value of $8.38. Recall that for a call, the intrinsic value will be equal to the stock price minus the strike price. So that's the intrinsic value of the call, right? But you can see that this call is selling at $9.05 over here. That's the ask price. So why does it sell above the intrinsic value? Well, because there's an extrinsic value, which is made up of the time value as well as the volatility. So if you take 905 minus 838, 905 minus 838, you can see that the extrinsic value is 67 cents. Right? So in total, this makes up the price or the premium of the option, which is 905. So there you go. All right. Now, notice that these options that are in yellow are in the money, which means they have got an intrinsic value. And normally, the more in the money they are, the higher the intrinsic value is and the lower the extrinsic value is. Now, on the other hand, let's look at an option that is out of the money, which is the one in white over here. So let's take the 50 strike, the 50 call strike, this one. So again, if you own this option, it means you have the right to buy Coke shares at $50. But right now, Coke's at $49.38. So by owning this option, you have the right to buy at 50, but it's at a lower price right now. So this option over here has no intrinsic value. The intrinsic value is zero. It is out of the money. But it's still selling at $1.30. Why? Why is there some value to it? Because for this option, the intrinsic value is zero. But the extrinsic value, which is the $1.30, is made up of the time value and volatility. So people are willing to pay $1.30 because there is still hope that Coke shares could go up and this could become in the money in the future. So they're willing to pay some time value that's left, some hope value, if you will. Now, the next thing that you want to know is what's the delta, the gamma, the theta, and the vega. So what does this mean? So delta tells you for every $1 change in the share price, how much does your option change in value? So notice that for options that are very deep in the money, it's got a very high delta. So the delta is 0.89 and 0.88, 0.86, 0.83. And as you go out of the money, the delta goes down. So for example, an option that's out of the money has a delta of 0.45. So what does this mean again? So a delta of 0.89 means that for every $1 increase in the share price of Coke, this option will increase in value by 89 cents. And if you go further deeper into the money, eventually the delta will become 0.99, which means that the option will move together with the share price. Share price goes up by $1, the option will go up by close to $1 as well. But if you look at this option over here, it's got a delta of 0.45, which again means that if Coke shares increase by $1, this option will only increase by 45 cents. Right? So that's how you read the delta. Now the same goes for puts, we'll see in a while, except the delta is negative. Deltas are negative for puts and positive for calls, because for puts it's the opposite, right? The share price goes up by $1, the put goes down by a certain amount. So it's the opposite, so it's a negative delta over here. So what does gamma mean? Now again, notice that as the stock price goes up and the option gets more and more in the money, the delta will increase, right? The delta will increase as the share price goes up. So how much does the delta increase as the share price goes up? Well, it tells us, well, the gamma is what tells us that, okay? So gamma is the rate of change of delta. So a gamma of 0.02 means that for every $1 increase in the share price, this option will increase its delta by 0.02. Similarly, for this option, for every $1 increase in the share price, the delta will increase by 10 cents. Okay, so if delta is speed, gamma is acceleration. The next thing is theta. Now theta is what we call time decay. So when you see a theta of minus 0.01, now notice on the call side and on the put side, theta is negative on both sides. Why is it negative? Because like I said, every day that passes, you're losing time value. So a theta of minus 0.01 means every day that passes, this option loses 1 cent, right? Every day you hold it, it's losing 1 cent and 1 cent and 1 cent, eventually nothing left, right? And extrinsic value goes to 0. Now, as the option goes closer to expiration, the theta will accelerate. In other words, the theta will increase the closer you are to expiration. And that's why you want to sell your options for profit, if you can, at least about 30 days before expiration. Because if you hold it too near expiration, you lose the time value too quickly. The next thing is Vega. Vega, well, think of V as in volatility. Theta T is time, right? That's how I remember it, right? So Vega tells you how sensitive is your option to changes in volatility. Recall what I said earlier. When volatility increases, option prices increase, both calls and puts. When volatility drops, call and put prices drop as well. Now, by how much do they drop? We measure it using Vega. So notice again on both sides of the equation, calls and puts, Vega is positive for calls and it's also positive for puts, right? Okay, so a Vega of, for example, 0.04 or 4 cents, what does it mean? It means for every 1% increase in implied volatility, this option will increase by 4 cents. And if implied volatility drops by 1%, this option will lose 4 cents in value. Hence, we tend to want to buy options when volatility is low and sell options when volatility is high. So that's how you read the Greeks in an option chain. Now, let's quickly run off to the puts over here. So for the puts, you can see it's the opposite, right? The ones in yellow over here, they are in the money. And the ones in white are out of the money. So let's take a look at one that's out of the money. So again, the current share price is $49.38. So if you take a look at the 55 strike, right? The put 55 strike. Again, what does this option do for you? If you own this option, it means you have the right to sell Coca-Cola shares at $55. But right now, it's selling at $49.38, which means theoretically, if you own this option, you could buy Coke shares at $49.38 and sell it at $55. So 55 minus $49.38 gives you an intrinsic value of $5.62. So recall for puts, the intrinsic value is the strike price minus the stock price. So 55 minus 49.38, intrinsic value is $5.62, right? But again, This put is selling at 570. That is the ask price. So it's higher than the intrinsic value by 8 cents. So that tells you that this option has an extrinsic value of 8 cents. So intrinsic value plus extrinsic value gives you the total premium, which is 570. There you go. So this is in the money. And again, notice that in the money, the delta is really high. It's minus 0.99, which is almost 1. So this means that for every $1 fall in the share price, this option will increase by 99 cents. Let's take a look at an option, a put option that's out of the money. So this one has a strike price of, for example, a 46 strike. Right? So again, what does this mean? So if you own this option, you have the right to sell Coke shares at 46. But right now, Coke shares are 49. So you can see that this option is pretty worthless, because why would you sell it at 46 when you can sell it at 49, right? So being worthless, there's no intrinsic value. This put option has got 0 intrinsic value. But it's still selling at 45 cents. Why? Why are people willing to pay 45 cents? Because there's hope that it could go in the money if Coke shares go down. Because there's time value left and there's volatility left that will shift the stock price. So the extrinsic value of this option is 45 cents. It's the hope value, if you will. And again, notice that options that are out of the money, they have got a lower delta. So the delta in this case is 0.19, 19 cents delta, which again means that for every $1 of fall of Coke shares, this option will increase only by 19 cents. All right, so again, as you go more in the money, delta increases. And again, what does gamma mean? Gamma means the change in delta with every $1 change in share price. So again, as the share price goes down, this option will increase in delta by 7 cents. This will increase in delta by, well, no more, right? Because it's really maximum delta, if you will. Again, theta is T. So it's the time value. It tells you how much the option decays every single day. That's vega, which is volatility, how the option price changes with volatility. So basically, that's how you read an option change.